Welcome to the Research Desk.
Glad to be here.
Usually, when we sit down to examine global macroeconomic shifts, we expect the incoming data to tell a relatively straightforward linear story. A country is either sinking into the mire of a recession, characterized by falling prices and contracting multiples, or it's clawing its way out into a healthy, demand-driven recovery.
Right. You look at the inflation prints, you look at the equity multiples, and you categorize the regime. It's usually that simple.
Exactly. You place it neatly into a historical bucket. But then you step back and look at China right now. The Chinese economy is experiencing its first real brush with inflation in 4 years, and suddenly the classic models they fracture completely. We're looking at a macroeconomic landscape that is incredibly complex and entirely counterintuitive.
Oh, it's a massive anomaly.
It really is. Consider the raw data we are presented with today. Think about this for a second. Oil is back above $100 a barrel. Standard Chartered just lifted its 2026 China Consumer Price Index forecast to 1.2%, and crucially, they expect the Producer Price Index to finally average positive 0.8%.
Which is a huge pivot from where we were.
Massive. And based on this, we have major institutional voices like UBS arguing that the MSCI China Index has 20% upside from current levels.
Wow. Just wow.
Right? And sitting at the center of all this is a glaring valuation anomaly. The Hang Seng is trading around a 9.5x earnings multiple, compared to roughly 25x for the S&P 500. So investors face a deceptively simple choice here. Buy the turn, assuming this is a generational opportunity and a genuine reflationary recovery, or avoid a massive value trap dressed up as reflation. I'm taking the bull case here, because I think the regime shift is real.
And I am absolutely taking the bear case. I look at those exact same data points, and I experience profound incredulity that anyone could interpret them as a signal of a healthy economic engine restarting. It is an illusion. We are witnessing a fundamental misdiagnosis of what actually drives prices higher in a modern, fractured global economy.
You don't think reversing the deflationary trend matters?
I think the bull case rests on a deeply flawed premise that all inflation is created equal. I look at oil above $100, I look at that projected 0.8% producer price index, and I do not see a recovery. I see a brutal, margin-crushing environment for the vast majority of corporations operating within that ecosystem. The choice is indeed stark, but the data screams caution.
Well, let's unpack that, because I think we need to look at the baseline. China has spent years trapped in a deeply entrenched deflation psychology. To understand why these new data points matter, why that 1.2% CPI matters, we have to walk through the mechanical reality of what deflation actually does to an industrial base.
Sure.
When prices fall consistently, month after month, human behavior changes at a fundamental level. A factory manager delays purchasing raw materials because, those materials will be cheaper next quarter. Consumers delay buying durable goods. And most importantly, the real burden of corporate debt increases.
Because the nominal revenues are shrinking.
Exactly. A company borrows money expecting a certain level of nominal revenue to service that debt. When producer prices contract, their nominal revenue falls, but their fixed debt obligations remain exactly the same. It acts as a severe, grinding tax on industrial cash flow. Moving from that outright deflation to even modest inflation, like that 1.2% CPI and 0.8% PPI, fundamentally changes the arithmetic of debt and inventory.
By Western standards, though, 1.2% inflation sounds entirely underwhelming.
Oh, absolutely. For a Western central banker, it would signal a failure to hit mandate targets. But for China's industrial base, this is a massive regime shift. Reversing a long period of producer price deflation is the exact catalyst required for a broad market re-rating. It restores nominal growth, it repairs the earnings transmission mechanism, it allows heavily indebted industrial firms to finally breathe and service their liabilities through top-line revenue expansion.
Okay, but so what actually happened? Think about this for a second. You're suggesting that because prices are no longer falling, prosperity is returning. That conflates higher input costs with expanded corporate profits. What we are seeing in China right now is absolutely not a classic demand pull reflation, where consumers feel wealthy, demand more goods, and producers raise prices to capture that enthusiasm.
You think it's entirely supply side?
100%. This is overwhelmingly supply-side repricing. It is structural cost-push inflation. It's driven by geopolitical de-risking, the reshoring of vital components, the creation of duplicated capacity across the globe, and aggressive strategic stockpiling of essential commodities. The world is intentionally making itself less efficient to buy resilience.
I wouldn't say less efficient. I'd say
No, it is less efficient. And to understand why this crushes margins rather than expanding them, we have to look closely at the mechanics of bottleneck inflation. Let's return to the container shipping shock in 2021. Walk through the data with me. Before the pandemic, shipping a standard 40-foot container from Shanghai to Los Angeles cost roughly $2,000.
right.
By September of 2021, securing that exact same route on the exact same vessel skyrocketed to over $20,000. Global prices for end products rose as a result. Nominal revenues for the companies selling those products rose. But did that $20,000 freight rate make downstream manufacturers more prosperous? Did it improve their free cash flow?
Well, obviously not the downstream players.
No, it didn't. Firms paid those exorbitant rates simply to secure inventory and keep their assembly lines moving. Delivery times stretched into oblivion. The downstream manufacturers had to eat those immense logistics costs. Their operating profits deteriorated entirely despite the higher nominal selling prices at the retail level. That period established a crucial immutable principle of modern economics. Inflation can return with a vengeance without prosperity returning with it.
Okay, but the container shipping shock was an acute, exogenous shock caused by a simultaneous global lockdown and a synchronized shift in consumer spending from services to goods. It was a freak event. What China is engineering right now is a deliberate strategic realignment of its industrial capacity.
But the costs of that redundancy are the same.
The costs of supply chain redundancy are very real, yes. I do not deny that creating duplicate systems requires massive capital expenditure. But we must recognize that China's underlying cost structure still highly favors specific dominant industries. Even with the geopolitical friction and the tariffs, look at the reality of global manufacturing costs over a long time horizon.
You're talking about the manufacturing cost index.
I am. The Manufacturing Cost Index tracks the relative expense of producing goods across different nations. Let's index China at 100 and look at how the rest of the world stacks up over the past decade. 10 years ago, Mexico stood at 120 relative to China's 100. Today, Mexico has moved down to 105.
Right, narrowing the gap?
Narrowing, but still higher. The United States has moved from 145 down to 125. Germany went from 160 to 140. Vietnam is now at 98, slightly undercutting Chinese labor costs. So yes, the gap has indeed narrowed. Chinese labor is no longer the infinite, ultra-cheap resource it was in the early 2000s. But China remains the absolute scale producer with the fastest industrial learning curves on the planet. They possess the deepest, most integrated supplier networks.
Scale doesn't negate the cost of inputs, though.
It does when you compare it to the alternative. Consider what it takes to build a modern semiconductor facility today. Look at Taiwan Semiconductor Manufacturing Company building its new fab in Arizona. The projected cost for that facility is over $40 billion.
Yeah, it's staggering.
That figure is not merely a semiconductor anecdote. It represents the literal price tag of redundancy. It is the quantifiable cost of Western nations attempting to rebuild ecosystems that took China 3 decades to perfect. If Western production is structurally more expensive because the West is forcing itself to pay a massive inflation premium for supply chain resilience, then Chinese firms that remain globally competitive deserve much higher multiples than the current 9.5x price-to-earnings ratio allows. They're the efficient baseline in a world voluntarily choosing inefficiency.
But you're relying heavily on aggregate index numbers there. Assuming a rising tide of global inflation lifts all Chinese industrial boats equally. This obscures the profound micro-level fragility hidden beneath those top-line figures. The story of China's current economy is a story of intense dispersion.
Dispersion, sure, but the winners will win big.
You must contrast the massive state-backed exporter with the small independent factory in Guangdong. A large state-owned enterprise or a top-tier exporter has the balance sheet scale to hedge raw material inputs years in advance.
They have the volume to negotiate favorable long-term freight contracts. They possess enough market share to push some of those rising input costs onto foreign buyers without immediately losing the contract.
Which proves my point about the multiples.
Wait, let me finish. Now, examine the financial reality of a mid-sized injection molding facility in Dongguan. They produce plastic enclosures for consumer electronics. Their revenue is dictated by contracts signed 6 months ago with Western buyers who are currently facing softening retail demand at home. Those buyers are actively demanding price cuts, threatening to move production to Vietnam or Mexico if the Dongguan factory does not comply.
Because Vietnam is sitting at that 98 on the cost index.
Exactly. Meanwhile, look at the factory's cost structure. The resin they use is tied to petroleum derivatives, and as we said, oil is back above $100 a barrel. Their electricity rates are rising because local utilities are passing on the costs of securing alternative coal and liquefied natural gas shipments in a tight global energy market. Freight is more expensive. Wages are creeping up due to demographic shifts.
It's a squeeze.
It's a vice. The factory owner cannot pass a single cent of that increased resin or electricity cost on to the Western buyer. The factory owner must absorb the entire commodity spike internally. Their gross margin collapses from 8% to 2%. Claiming that this inflation is a net positive because it is driven by geopolitics rather than traditional cost-push dynamics is a dangerous misdirection.
Well, hold on. The origin of the price increase fundamentally dictates how durable the trend will be and how capital should be allocated to capture it.
The origin matters for the geopolitical narrative you read in the newspaper, sure, but it does absolutely nothing to alter the accounting reality on a corporate balance sheet. Consider a horrific car crash.
A car crash?
Yes, think of a car crash. You can argue endlessly that the crash was caused by driver fatigue rather than a sudden physical collision with a deer. The geopolitics, the fatigue, explains the underlying cause of the structural shift, but the physical collision, the immediate violent event, still arrives in the company's financial accounts as brutal input inflation. The profit and loss statement does not care if copper is expensive because of a cyclical global construction boom or because nation-states are engaged in strategic stockpiling for defense industries.
It's still a higher expense.
Exactly. The profit and loss statement just knows copper is expensive. When copper is expensive and end consumer demand is weak, the company loses money.
Period. Okay, I reject the premise that this dynamic leads to universal margin destruction. It ignores the structural winners in a fractured world. Let's use your car crash analogy. If the roads are suddenly and permanently more dangerous, the companies manufacturing the airbags, the reinforced chassis, and the collision avoidance systems become incredibly valuable. Let's apply this to the picks and shovel strategy in this exact macroeconomic environment.
I'm listening.
There is a massive, quantifiable advantage right now for Chinese exporters who sell their finished products in US dollars while keeping their underlying cost base, particularly their labor and domestic overhead, in renminbi. We see this explicit advantage playing out in machinery, complex chemicals, and advanced textiles.
But those are highly specialized segments of the broader economy.
They are specialized, which is precisely what makes this a selective earnings catalyst rather than a broad index call. When global inputs spike due to supply stress, the firms sitting closest to the strategic bottlenecks gain incredible pricing power and accumulate vast amounts of capital. Consider the lithium carbonate surge that occurred between 2021 and 2022.
Oh, that was a wild cycle.
It was. Look at the exact numbers. Prices surged more than 400% in a remarkably short window, peaking above 500,000 yuan per ton. Downstream electric vehicle manufacturers suffered immensely. They faced acute input cost pressure and saw their vehicle margins evaporate overnight. But that massive price shock accelerated extraordinary investment in lithium extraction, chemical processing, and next-generation battery innovation.
Right. The upstream players made a fortune.
Exactly. The firms controlling the bottleneck, the processing facilities, and the miners captured extraordinary wealth. They generated years' worth of free cash flow in a matter of months. In reflationary episodes driven by supply stress, the undeniable winners are the firms selling the picks and shovels of industrial adaptation. Right now,
Chinese industrial policy is pivoting violently to dominate those exact bottleneck sectors on a global scale.
Okay, but you are asking an investor to justify a broad market re-rating based entirely on the exceptional performance of a handful of bottleneck monopolists. We must address the E in the 9.5x price-to-earnings ratio you highlighted in your opening thesis. A 9.5x multiple looks like a generational bargain on a Bloomberg terminal.
Because mathematically, it is extremely low.
But academic valuation theory dictates that equity multiples cannot sustainably re-rate on price indices alone. They re-rate on durable, predictable future cash flows. That 9.5x PE becomes a devastating value trap if the earnings component is only temporarily flattered by inventory gains. When those inputs clear, when the supply chain normalizes slightly and unit volumes remain weak because end consumers are exhausted, those earnings will revise down sharply. Suddenly, your 9.5x PE becomes a 15x PE.
Even if prices stabilize?
Yes, because it does not become a 15x PE because the stock price went up, which would generate a return for the investor. It becomes a 15x PE because the denominator, the earnings, collapsed.
But if the producer price index turns positive and sustains that trajectory, nominal revenues improve across the board. That mathematical reality eases the burden of debt servicing for the entire industrial sector.
Nominal revenues only translate to durable earnings if the firm possesses the pricing power to pass those elevated costs down the line to the final consumer. If pass-through capability is limited by weak consumer demand, index-level earnings quality deteriorates rapidly. Look closely at the behavior of the financial sector right now for a real-time indicator of confidence. Look at Ping An Insurance.
What about them?
Ping An's recent efforts to aggressively dodge duration risk on their balance sheet is a massive, flashing red warning sign. Duration risk, in this context, involves holding long-dated fixed income assets that lose immense value if inflation takes hold and interest rates rise. Large balance sheet allocators in China manage hundreds of billions of dollars. They possess the deepest proprietary data in the market. They do not trust a clean, nominal growth rebound. They are positioning their massive portfolios defensively. We have seen this exact mechanical sequence play out historically. Examine Japan in the early 2000s.
Oh, Japan's demographic collapse and their specific post-bubble balance sheet dynamics in the early 2000s were fundamentally different from China's current transition toward advanced manufacturing.
The macro-structural nuances certainly differ, yes. China is much larger and still developing its interior provinces. But the mechanical reality of cost-push inflation occurring within a weak demand environment is identical. In Japan during the early 2000s, the global economy delivered periodic, sharp commodity spikes, often driven by Chinese urbanization. Did those external commodity spikes cure Japan's chronic domestic weakness? Did they spark a vibrant recovery?
Well, no, but
No. Input costs for Japanese manufacturers rose. Because domestic Japanese consumer demand was historically anemic, those producers could not raise end consumer prices without completely destroying their sales volumes. They simply absorbed the costs internally. It led to intense corporate stress, a wave of silent bankruptcies, and widespread margin destruction. It did not lead to healthy reflation. That is the grim reality of the margin squeeze.
Look, I acknowledge the margin squeeze is a profound threat for downstream commoditized producers who lack technological differentiation. However, we must also evaluate the massive, systematic investments in automation and industrial efficiency that these exact pressures are forcing into existence. I return to the TSMC Arizona fab. The projected cost of over $40 billion is astronomical. The West is deliberately building structurally more expensive production nodes to secure its supply chains against geopolitical shocks.
Which makes the entire global macroeconomic system structurally less efficient and inherently more inflationary.
It makes the global system less efficient, yes. But that inefficiency is precisely why Chinese firms that remain globally competitive are uniquely positioned to capture unprecedented market share. If the baseline cost of manufacturing in the Western Hemisphere is artificially inflated by this $40 billion redundancy tax, then Chinese advanced manufacturing, logistics technology, and domestic automation sectors become mathematically indispensable.
Indispensable to whom, though?
To themselves and the emerging markets. They are aggressively substituting expensive imported inputs with cheaper domestic alternatives. They are upgrading their factory floors with robotics to offset any demographic wage pressures. They are taking global market share because the Western alternative is simply too expensive for the average consumer to bear. A company that can maintain its margins while its global competitors are forced to raise prices by 30% justifies a significantly higher equity multiple.
You're assuming the global market will continue to freely absorb Chinese exports without erecting further insurmountable tariff walls. That is a massive geopolitical gamble that no risk manager should take lightly. But let's set the global export market aside for a moment, because there is a massive internal wildcard that will ultimately decide the outcome of this economic transition: domestic demand and the terrifying threat of debt deflation.
You're focusing on the property sector and the domestic consumer sentiment here.
Absolutely. The absolute nightmare scenario for any modern economy is cost-push inflation coexisting simultaneously with debt deflation. That is exactly the precipice China is staring down right now. We cannot have a serious discussion about a reflationary recovery without pointing directly at the unresolved systemic property distress. Look at Vanke and Country Garden.
The big developers.
These were the titans of Chinese real estate. Their distress involves hundreds of billions of dollars in liabilities. They are not just isolated corporate failures born of bad management. They are towering symbols of a completely broken macroeconomic transmission mechanism.
The property pain is severe, I'm not denying that. The restructuring of that sector will take years, and the loss of wealth is undeniable.
But it is not merely financial pain on a spreadsheet. It dictates human consumer behavior on a massive scale. Think about the behavioral economics at play here. For over 2 decades, the average Chinese household relied on real estate as their primary and often only reliable store of wealth. When households lose trust in housing as a mechanism to preserve their savings, their entire psychological framework shifts violently.
They lock up their wallets.
They absolutely do. They do not look at oil ticking above $100 a barrel and a CPI print of 1.2% and think to themselves, the economy is recovering nicely, I should go buy a new electric vehicle or upgrade my household appliances. They do the exact opposite. They trade down in their consumption habits. They hoard liquid cash and low-yielding bank accounts. They view that mild 1.2% CPI not as a growth signal, but as a punitive affordability tax on their daily lives.
I concede the severity and the depth of the property trap. Cost-push inflation in construction materials, for instance, cement and structural steel prices ticking up because of elevated global energy costs, does not magically revive apartment sales in Tier 3 cities. It simply bankrupts the remaining suppliers faster because developers cannot pay them. The transmission mechanism from rising producer prices to confident consumer spending is indeed deeply fractured right now.
So how do you possibly justify the bull case to an investor if the domestic consumer is actively hoarding cash and the foundational property market is structurally impaired?
Because of what I call the chess sacrifice analogy, what Chinese policymakers are doing right now requires a long-term lens. They are buying supply chain resilience and aggressively transitioning the entire economy away from a debt-fueled, property-led growth model toward an advanced manufacturing-led model. This is exactly like a grandmaster in chess willingly sacrificing a pawn or even a highly valuable knight to secure an insurmountable positional advantage later in the endgame.
A pawn? Property is a lot more than a pawn.
A knight, then. The near-term property pain is excruciatingly real. The localized debt deflation dynamics impacting municipal governments are real, but they coexist simultaneously with long-term, strategic, state-directed gains in automation, green energy infrastructure, battery technology, and industrial upgrading. Policymakers are intentionally letting the old, inefficient, massively indebted property model deflate. They're refusing to bail it out with massive stimulus, while simultaneously redirecting all available credit and capital into the precise sectors that will dominate the 21st century global economy.
That is a brilliant theoretical narrative for an academic paper. It is incredibly difficult to invest capital based on a chess sacrifice when you have absolutely no idea how long the middle game will last or how many other pieces will be violently taken off the board in the process of reaching that theoretical endgame. This brings us to the actual execution of portfolio strategy.
Right, the execution.
If we both look at the data and agree that the macro headlines might superficially improve while the microeconomics worsen for the vast majority of companies, how does a sophisticated allocator actually navigate this landscape without stepping on a landmine?
This is where our perspectives actually converge toward a highly specific shared verdict. Despite our different framing of the overarching narrative, we both agree that this is absolutely a dispersion trade, not a simple macro beta trade. You cannot just buy the broad MSCI China index blind, close your eyes, and expect that projected 20% upside to materialize evenly across your portfolio. We have to meticulously walk through the exact portfolio execution. There are 7 specific portfolio rules we need to lay out for an allocator operating in this specific environment.
Okay, let's go through them. Rule number 1, treat this explicitly and exclusively as a dispersion trade. For the next 12 to 18 months, investors need to completely abandon broad index exposure. You must favor a strict barbell approach. On one side of the barbell, you want the highly competitive, dominant exporters who control their niches globally. On the other side of the barbell, you want the state-backed, policy-driven industrials that are entirely insulated from the weakness of the domestic consumer.
Which leads directly to the specific weightings in rule number 2. We recommend an overweight position in machinery, complex chemicals, and selected advanced textiles by exactly 7%.
7%.
Yes, exactly 7%. The mechanical why behind this number is crucial. These specific sectors represent the clearest, most direct beneficiaries of the structural dynamic we discussed earlier. They possess dollar-denominated pricing for their global exports, which protects their revenue from currency depreciation, but their fixed cost base remains heavily in renminbi. They have deeply embedded, sticky customer relationships and relatively contained domestic labor costs. If the producer price index stays positive at that plus 0.8% forecast and global oil remains elevated above $100, this targeted 7% tilt captures the pure margin expansion over the next 12 months as they pass costs through in dollars while paying their workers in renminbi.
I agree with that specific 7% tilt, provided the valuation discipline holds firm. Now, rule number 3 addresses your chess sacrifice theory directly and seeks to monetize it. Add exactly 7% to automation, logistics technology, and domestic supply chain resilience equities.
The resilience premium.
Exactly. Think about the mechanics. If the world is forcing massive redundancy costs into the system, if TSMC is forced to spend over $40 billion to build a single fab in Arizona, then Chinese domestic manufacturers are going to be forced into rapid local substitution to survive. They must upgrade their productivity to offset any loss of access to Western technology, focus entirely on robotics, precision engineering, and advanced manufacturing software. Over a 12 to 18-month investment horizon, that 7% allocation is designed to capture the massive, state-directed capital expenditure cycle flowing away from real estate and into industrial upgrading.
But to fund those significant overweight positions, we must make deep, merciless cuts elsewhere in the portfolio. Rule number 4 is the natural, unavoidable consequence of your debt deflation warning. Underweight property developers and property-linked credit instruments by at least 7%.
At least 7%, yeah.
Vanke, Country Garden, and the vast, interconnected ecosystem of material suppliers and local government financing vehicles attached to them are trapped. Cost-push inflation in raw materials cannot, and mathematically will not, solve a balance sheet recession. If cement and steel get more expensive, developers simply bleed their remaining cash reserves faster. Avoid the entire sector completely until the bad debt is fully cleared.
Rule number 5 targets the behavioral economics of the Chinese household we discussed earlier. Cut consumer discretionary and import-dependent technology sectors by 5 to 7%.
These specific sectors are currently facing the absolute worst possible combination of macroeconomic factors. They suffer from incredibly weak end demand because of the massive wealth destruction in the property market. Simultaneously, they are facing rising costs for imported inputs, microchips, and energy. They have zero pricing power. They cannot pass a single percentage point of those costs on to a defensive, cash-hoarding consumer. Their operating margins will simply vanish.
This brings us to rule number 6, which governs the entire strategy. Extreme valuation discipline. A 9.5x earnings multiple is entirely meaningless if the underlying earnings are a mirage created by temporary inventory restocking. We must demand absolute empirical proof of pass-through capability and stable, recurring free cash flow. Do not buy a stock just because it looks historically cheap relative to its 10-year average. In a regime shift from persistent deflation to structural cost-push inflation, historical equity multiples are completely irrelevant. You have to underwrite the future cash flow based on their pricing power today.
Finally, rule number 7. We must clearly define the macroeconomic triggers that would require us to change our defensive stance. There are 3 specific, measurable data points to watch. First, we need to see retail sales growth sustained above 6% year over year for 2 consecutive quarters. That specific metric would prove the domestic consumer is actually absorbing the mild inflation, wages are rising, and real end demand is genuinely recovering.
Second, watch the spread between producer prices and consumer prices. If the PPI rises more than 3 percentage points above the CPI and stays there for 2 quarters, that is a massive, system-wide red flag.
It's toxic.
It mechanically signals severe margin stress. It means industrial producers are paying higher costs, but are forced to eat those costs entirely because they cannot pass them to the retail consumer. That scenario would require an immediate aggressive defensive pivot across the entire portfolio.
The third trigger is concrete stabilization in property sentiment and local government finance. We need to see floor space sold stabilize and local government land sales recover. Until that specific transmission mechanism is repaired, the quality and durability of this entire reflation narrative remains highly suspect.
Looking at the entire macroeconomic landscape, the final synthesis is clear. China is not re-entering the old, hyper-efficient, debt-fueled growth regime that defined the last 2 decades. It is entering a more inflationary, but globally less efficient regime, characterized by supply chain duplication and geopolitical friction. The macro headlines will undoubtedly look better. Economists will cheer that deflation is officially ending. But the microeconomics for individual companies operating on the ground are going to be a bloodbath for those without distinct technological advantages or absolute pricing power.
The source material summarized this harsh reality perfectly. It is a line every serious allocator needs to memorize before deploying capital into this market. Quote, "In this market, the danger is not missing the rebound. It is owning the margins that disappear."
So as supply chains continue to fracture and rebuild, you have to ask yourself, in your own portfolio, are you buying the bottleneck or are you paying the redundancy tax?
This is the Research Desk officially signing off.